We've had a lot of conversations about this with investors in the past few days. We think the answer is no. We think what China's doing is it's kind of passively allowing the renminbi to depreciate, which it should be doing in the current environment. Just a couple of data points here. The renminbi appreciated 4% until April. It's since given up about 5%, 6%, slightly down on the year. That's recently moving roughly in line with the TWI, the trade-weighted index. The reasons why we don't think that they would use it as an offensive weapon are twofold. Number one, if there was a sudden, say, 10% devaluation, that would be a red flag in front of a bull. You would have an immediate escalation of trade tensions, so you probably would not achieve the objective you were aiming for. Number two, you have to remember that when they had many devaluations in 2015 and 16, there was an immediate outflow of capital market pressure, because market expectations changed, and we don't think they want to go anywhere near opening up that Pandora's box again.
Market expectations are changing. The Shanghai comp is in a bear market. What does that reflect?
Okay, I think it reflects basically two things, and kind of, or maybe a combination of, frankly, toxic factors or poisonous near-term factors. So obviously the topical one is trade and the uncertainty about that. We can talk a bit more about that in a moment. The other one domestically is that policy has been tight deliberately to deal with some of the excesses of credit that had accumulated in recent years, in which we've discussed about previously. So China policymakers are doing sort of the right thing to cut down on shadow banking, but that is constricting credit, and domestic investors are concerned about that. So the combination of tight domestic policy with external uncertainties is resulting in sort of, sell first and ask questions later mentality.
So when you talk about offensive moves, then what is possible or likely from them?
From a trade perspective?
Yes.
I think actually, I'm not sure it's going to be offensive. The feedback we're getting from policymakers is that we don't want to fight, but if you confront us, then we'll meet you, right? I mean, Xi Jinping was just on the tape recently sort of talking about not turning the other cheek, but punching back. That was in a meeting with U.S. and leading CEOs in Beijing just a couple of days ago. So the sense we get is that China will sort of, try to match the U.S., or at least not appear to be backing down. And I think the key question here is how could things resolve somewhat? And our sense of a sort of face-saving agreement would have some sort of combination of ingredients of, number one, China buying more stuff from the United States, which already was discussed when Steve Mnuchin was in town there. Number two, some sort of agreement to protect intellectual property rights, which obviously is a key issue for the administration. Number three, because you can't deal with narrowing the trade deficit in one fell swoop, there would probably have to be some kind of forward agreement with some kind of KPIs along the way. And then probably number four, some sort of action or greater combination on the service side.
You see that coming in the next 6 months?
Well, the obvious date to look for would be the midterm elections, and having some sort of an agreement before that, which would be politically expedient. That's not a guarantee, but if you wanted to have some sort of rational expectation, having some sort of an agreement negotiated before that would be politically acceptable, as long as from a face standpoint that would be palatable to both sides.
Specific to the sort of back to the banks and recognizing what has been, what was more lending that should have taken place over a long period of time.
Yeah.
Have they started to really take the marks? And what do we make of the decision to lower the reserve requirement?
Okay, so the answer, David, is that they clearly are taking action. And one key statistic we look at is what's called total social financing, which is the broadest measure of credit. If you just aggregate that into bank lending and then so-called shadow banking, and there's a couple of other bits and bobs in there, but the main components are those first two. What's interesting is that bank lending has been very consistently stable at about 10 to 12% annual growth every month. It's shadow banking that's really come down. It's very clear from the data that the policymakers are cracking down on this sort of less regulated, kind of Wild West shadow banking which has taken place. In the long term, that's absolutely what should happen, and it's good. In the near term, it's constricting credit, and investors are concerned about that, and that's where you're getting this sort of downward fueled selling in the A-share market.
So to wrap it all up, Tim, it sounds like you're optimistic that there will be some sort of grand bargain here when it comes to the U.S. and China. I guess investors want to know, though, how much damage and pain will be leading up to that point. How bad can it get for both sides and for both economies?
I don't want to sound Pollyanna here. I mean, there is risk further to the downside. I think that's what the market's pricing. If you just spot check things right now, the announced $50 billion of tariffs is not going to move your profits, not going to move your GDP forecast. What the market is pricing is sort of like today's weather, uncertain clouds and the threat of rain or thunderstorms and so forth, and that could get worse depending on how the rhetoric escalates. So and that coming against a tighter domestic credit situation is causing this downward spiral. So our sense here is that it's probably going to stay choppy in the near term because the news flow will still be unclear. On a sort of 3-month view, we might get something that the market likes, and against the context of the stock market have been sold down a lot. Valuations coming down to 11 times earnings for the Shanghai Stock Exchange and for 12 times earnings for the offshore stocks listed in Hong Kong. We think that would give you an opportunity for a decent bounce.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.